To succeed in mutual fund investing, avoiding mistakes is just as important as making the right choices. Let's dive into the biggest pitfalls and how you can avoid them. Investing without a goal. Know your destination before you start. The mistake. Many investors jump into mutual funds without a clear financial goal. They invest randomly without thinking about why they are investing and how long they should stay invested. Why this is a problem. Your investment choices should align with your financial goals. Without a goal, you may end up investing in the wrong type of fund and withdraw early. Example, if you are saving for a house in 5 years, investing in a high-risk, small-cap equity fund might not be ideal. Instead, a balanced or debt fund would be more suitable since it provides stability. How to avoid this mistake? Before investing, ask yourself, am I investing for short-term, 0 to 3 years, medium-term, 3 to 7 years, or long-term, 7+ years? What is my goal? Retirement, home purchase, child's education, or wealth creation? Based on my goal, should I invest in equity, debt, or hybrid funds? Pro tip: always match your investment horizon with the right mutual fund category. Chasing past performance, the last year's winner trap. The mistake. Many people invest in mutual funds just because they performed well last year. They assume past success will continue forever. Why this is a problem? Markets change and no fund performs well every year. A fund that delivered 50% returns in 2023 might give -10% in 2024. Instead of looking at just last year's performance, focus on the 3-year, 5-year, and 10-year consistency. Example, in 2020, many technology sector funds gave high returns, but in 2022, they underperformed. Investors who blindly followed past winners suffered losses. How to avoid this mistake? Look at long-term performance trends like 3, 5, or 10 years. Compare the fund's performance against its benchmark and peers. Check risk-adjusted returns, such as the Sharpe ratio, instead of just focusing on absolute returns. Pro tip: a consistent 12 to 15% return over 5 years is better than a 40% return in 1 year followed by losses. Ignoring risk. Every investment has a risk factor. The mistake: people often invest in high-risk funds without understanding their own risk tolerance. They see high returns and jump in, only to panic during market crashes. Why this is a problem? If you invest in high-risk small-cap funds but can't handle volatility, you might sell during a market dip and lose money. Not every investor has the same risk tolerance. Choose funds that match your comfort level. Example, during the COVID-19 market crash in 2020, many investors panic-sold equity funds, locking in losses. Those who understood the risks and stayed invested saw massive recovery gains in 2021. How to avoid this mistake? If you're risk-averse, consider hybrid or debt funds instead of pure equity. Use risk profiling tools on platforms like Grow, Value Research, or Morningstar before investing. Pro tip: if you lose sleep over market fluctuations, you are taking too much risk. Not diversifying, putting all eggs in one basket. The mistake. Some investors put all their money in a single mutual fund or asset class. Why this is a problem? If that one fund or sector underperforms, your portfolio suffers. A well-diversified portfolio balances risk and return. Example, if you invested only in IT sector funds in 2021, you saw great returns. But in 2022, when IT stocks crashed, your portfolio suffered badly. How to avoid this mistake? Invest across different fund categories such as large cap, mid cap, small cap, hybrid, and debt. Diversify across multiple sectors instead of focusing on just one. Pro tip: a good mutual fund portfolio has a mix of equity, debt, and hybrid funds based on your risk profile. Frequent switching, the costly habit of overtrading. Many investors switch between mutual funds too frequently, trying to chase the best returns. Exit loads and taxes reduce your returns. Short-term capital gains tax applies if you exit equity funds within 1 year. Frequent switching disrupts compounding benefits. If you keep switching funds every 6 months, you never allow compounding to work its magic, which is essential for long-term wealth creation. How to avoid this mistake? Stay invested for at least 3 to 5 years in equity funds. Review your portfolio once a year, not every few months. Pro tip: wealth is built by time in the market, not by timing the market. Investing without research, blindly following tips. Many people invest based on random tips from friends, relatives, or social media without doing their own research. Not every fund suits your financial goals and risk appetite. Many so-called hot stocks or best funds fail in the long run. Use trusted platforms like Morningstar, Value Research, and Money Control to analyze mutual funds. Understand the fund's objective, risk, and past performance before investing. Pro tip: investing blindly is like driving without a map. You're bound to get lost. Now that you know the most common mutual fund investing mistakes, you're on the path to becoming a smarter investor. In the next episode, we'll explore advanced topics like index funds and dynamic asset allocation funds to take your investing knowledge to the next level. Don't miss it. Subscribe to Stock Glimpse India and hit the bell icon. If you found this video helpful, hit the like button and comment below. What's the biggest investing mistake you've made? Let's learn from each other. Happy investing!